Hi everyone, this is Steve here from Sure Trading. In this video, I'm going to talk to you about moving averages, what exactly they are, how to use them in your trading, as well as sharing with you a very simple moving average strategy that you can use in your trading. As always, if you like the content you're seeing, please like the video and share it with your friends, as well as subscribing to our YouTube channel if you haven't done so already. Also, we have a free Telegram channel where we share trading content, tips and alerts, which you can sign up by clicking on the link below in the description. Great. So let's talk about moving averages. Firstly, what exactly are moving averages? Now, to give you a description of moving averages or a definition of moving averages, I'm going to read to you out of this book, How to Make Money on the Stock Exchange by Ross Lauter. I'm going to put a link below in the description so you can get your hands on a copy of your own if you'd like. So according to the book, a moving average is a technical indicator that refers to the average price of a particular trading instrument over a specified period. Moving averages smooth the price action to form a trend following indicator. So in layman's terms, a moving average is the average of the price of a certain amount of candles or periods that is plotted onto the graph as a line. So if you have a look at this over here, I have a 21 period moving average, this white line on the chart over here. This is a day chart. So each point on the moving average is plotted by taking the previous 21 periods, in this case days because it's a day chart. So this point where my mouse is at the moment is calculated by adding the last 21 candles together and dividing them by 21, and you get the average of those candles, and that is plotted on the chart. And then the next one would be the average of the next 21 candles and so forth. And so the moving average line moves as the price moves, and it's just worked out by calculating the average of the previous periods. So a lot of people use the moving average indicator as a indicator of trend because it smooths out the price action and gets rid of a lot of the noise in the market, so you can have a better idea of which direction the price is moving in. Because it's a trend indicator, a lot of people use it to enter or exit trades. So the idea behind that is that when the price is below the moving average, you are then in a downtrend. So that's a good time to go short. And when it's above the moving average, you're in an uptrend, and that's a good time to go long. So let's just have a look at this down move over here. If we had entered the trade solely on the fact that it crossed through the moving average and is now, the price is now below the moving average, we would have entered somewhere around here, and then we would exit again when the price moves up through the moving average, which happened over here. And if we had stayed in that trade, we would have potentially made about 10,100 Rand per contract on the US 500. But now, because the price moved through the moving average upwards, we would technically be in an uptrend from here, and you would enter again long, but as you can see, that didn't work out and we would have made a loss until we entered again over here, because the price moved through the moving average and is now above the moving average. So we would have entered again over there, and we would have stayed in the trade until it breaks through, which would be over there, and we would have potentially made about 2,000 Rand on that one. Now, as you can see, it breaks through the moving average and crosses either above or below rather often, which is a bit treacherous because it gives you a lot of false signals. So the way that we counteract that is we add another moving average. We add a faster moving average. So at the moment we have the 21 period moving average on the chart, Let me just get rid of these arrows. And if we add another moving average of a lesser period, so a 7 moving average, as you can see it's there in red. Now you can see this one's a lot closer to the price action because it is a faster moving average, meaning that it takes less of the candles into account because it's a 7-day moving average. So it only makes an average of the previous 7 candles as opposed to the previous 21 candles of the other moving average. But when you have 2 moving averages on your chart, it allows you to not fall prey to a lot of the false signals. So if we have a look at this example again, you would now enter when the 2 moving averages cross each other. In a downward direction, you would enter short, and in an upward direction, you would enter long. So in this example, you would enter at a similar place over here, and you would exit a bit later. So you would exit over here when this cross happened. So for this trade, you would have potentially made 8,000 Rand. But remember, over here there was a couple of false signals that happened, which you have now avoided because you got the 2 moving averages. So then you would enter again long where you exited short, so you would enter again over here, and then you would remain in the trade until it crosses downwards again, which is over here. Which is over here. And with this you would have potentially made a profit of 4,000 odd Rand. Once again, there's a bit of a false signal there, but when it crossed up again, you would enter over there and you would remain in the trade all the way to this point over here, and that would also give you a potential gain of about 4,600 Rand. And you would just continue entering short when it crosses downwards, like over there, and long when it crosses upwards over there, and so on and so forth. Let's just go and have a look at another instrument. Let's go look at a Euro US dollar pair. See what happens on that chart. As you can see, there's a massive upward turn over here. So you would enter over there because the moving average is crossed upwards. You'd remain in this trade all the way to the top over here where it broke through and crossed downwards, and with this trade you could have made a massive 53,000 Rand. Bearing in mind it was 125 days long, so it's quite a long-term trade. Now with the moving average crossover, you will get false signals as well, like you would with just a single moving average. As you can see over here, it got quite messy. Bunch of different crossovers. So you would make a loss over here, you would make another loss over here. So you would have a couple of losses in a row, but then you would enter long over here and exit at this point over here, and you can make a potential 25,000 Rand over there. So there you have it. I hope that explained a moving average and a moving average crossover to you. It's a very simple strategy. You can add a lot of other indicators to your charts just to get stronger confirmations, but this is a great starting point for knowing when the trend is changing and knowing when to enter short or when to enter long. Thank you so much for watching. I hope that you learned something from this video. We'll see you again very soon in the next video. Cheers.